In 2022, REITs had their worst year since the great financial crisis. REIT share prices dropped by right around 30% on average, and many of the smaller and lesser known REITs dropped by as much as 50%. But as surprising as it may sound, REITs actually did quite well. Their cash flows grew significantly and hit new all-time highs. Most REITs even hiked their dividends in 2022. And so as a result of this, now we have a lot of high-yielding investment opportunities in the REIT sector. But which one are the best? Hey everyone, this is Jussi. I run an investment firm that specializes in REIT investing, and in today's video I'm going to talk to you about two specific REITs that pay a dividend yield in excess of 8% that I'm buying at the moment. But before I get into it, if I could kindly ask you to like this video, it will help me a lot. I just recently created this channel and I plan to make weekly content on REIT investing going forward. Thank you very much. So the first REIT I want to talk to you about is called EPR Properties. Its ticker symbol is EPR, and EPR is a triple net lease REIT that specializes in experiential properties such as golf complexes, movie theaters, water parks, ski resorts, and hot springs, and plenty of other experiential properties. In 2022, its share price dropped by over 20%, but the company actually hiked its dividend by 10%. And as a result, now its dividend yield is unusually high at 8.3%. I think that the market is undervaluing EPR because of two key misunderstandings. The first one is that the market believes that EPR is going to suffer great pain from a coming recession. It believes so because most of its properties are experiential and so they rely on discretionary spending. But I don't think that this makes sense because EPR isn't actually the operator of these properties, it's their landlord. And today, the average remaining lease term that it has is 14 years. Rents are hiked automatically each year by 1.5% to 2%. And so, as long as its tenants can afford to pay their rent, EPR should earn very steady and consistent income that will rise year after year, whether we go into a recession or not. So what the market should ask itself is, can its tenant afford their rent? And if you look at the rent coverage ratio, which is right around 2 times at the moment, clearly tenants can pay their rent and they even have good margin of safety in case their profitability gets worse in the near future. The second misunderstanding relates to the movie theaters. EPR owns a lot of them and the market thinks that this sector is dying. I agree with the market that this sector is going through some severe challenges. It suffered greatly from the pandemic and box office still hasn't fully recovered. But where I think that we disagree is that I think that the highest quality movie theaters are here to stay and will keep doing well in the long run, and that's precisely what EPR owns. I think that the lower quality theaters, many of them will have to close down, will go bankrupt, but this will actually benefit the higher quality theaters because it will lower competition and lead to traffic consolidation from the lower quality theaters to the highest quality ones. Today, EPR owns about 3% of the theaters in Northern America, but they actually generate 8% of the total box office. So clearly, these are some of the most productive theaters in the nation, and I just don't see these going anywhere. Already today, these theaters are profitable with a rent coverage of 1.3%, even as we still emerge from the pandemic. In 2023, I think that the movie slate is going to get much better, and this is going to lead to a continued improvement in the rent coverage ratios. We just had Avatar come out. It's already one of the highest grossing movies of all time. So clearly movie theaters aren't dead. People still enjoy going there. But with all that said, I agree that movie theaters are riskier properties than most others. But then the question is, how much should you discount the company for this? Typically, net lease REITs trade at right around 15 to 20 times FFO, and their dividend yield is between 3 to 5%. But today you can buy EPR at just around 8.5 times FFO, and its dividend yield is over 8%. So that's a massive discount. I think that you should discount EPR, but I think that the discount here is excessive. we have to remember that only around 1/4 of the company's net asset value is invested in movie theaters, and the remaining 3/4 is invested in really well-performing assets like water parks, golf complexes, and so on, and these have rent coverage ratios of 3 times, which is really safe. Again, I think that you could perhaps price EPR at the current valuation if its entire portfolio was movie theaters and many of these were lower quality theaters, but that's not the case here. It's just a minority of its portfolio, and even this minority is performing surprisingly well because these are some of the highest quality theaters in the country. Despite all the naysayers, EPR has historically actually been very successful investing in these property sectors. It has massively outperformed the broader stock market as well as the REIT sector. Today it has a strong investment grade rated balance sheet with lots of liquidity to keep buying more assets. Its rents keep rising every year according to the lease terms. The rent coverage ratios of its tenants are improving, and so clearly I think that the company is now headed in the right direction, but it's still heavily discounted. I think that EPR is going to reprice at right around the 6% dividend yield in the future as the market gets more comfortable with the movie theater industry and we emerge from a future recession. This would unlock right around 50% upside potential from today's share price, and while you wait, you earn an 8% dividend yield that I believe is sustainable. The second REIT I want to talk to you about is called Global Medical REIT. Its ticker symbol is GMRE. Global Medical is a REIT that specializes in medical office buildings, and in 2022 it hiked its dividend by a small 2%, but its share price collapsed by nearly 50%. And so because of this, now it's also offered at a dividend yield in excess of 8%. Its share price dropped so much because the market is worried about the health of the entire healthcare sector today. It suffered greatly from the pandemic, and to this day, many operators of these properties are still losing money and fighting to stay alive. It had a particularly large impact on senior housing and skilled nursing facilities, which had labor shortages and labor costs went up significantly. But what the market appears to ignore here is that medical office buildings are actually a lot safer than senior housing and skilled nursing. The rent coverage ratios of medical office buildings are right around 5 times, whereas it is just 1 to 1.5 times for skilled nursing and senior housing, if even that. And so the risk of a lease default here is much lower because the tenants of medical office buildings are a lot stronger. Then I think that the market also probably overreacted to the recent surge in interest rates. Global Medical has about 20% of its debt with a variable rate, so its interest expense is going to go up. But this is not the end of the world. Global Medical also has 2.1% rent escalations in its leases, so this should compensate for the rising interest rate. I think that Global Medical is going to have a hard time growing in the near term, but with an 8.3% dividend yield, it really doesn't need to grow by much to reach double-digit total returns. And then in the coming years, I think that interest rates are eventually gonna come back down. I also think that the fundamentals of the healthcare sector are going to improve, and with that, I think we're gonna see a significant improvement in the market sentiment of Global Medical. Historically, it has typically traded at closer to a 5% dividend yield, and to return to that yield level, its share price would need to rise by over 50%. While you wait, you earn a high 8% dividend yield that I think is sustainable. And so to recap here, we have 2 REITs that pay an 8% dividend yield. I also think that they have significant upside potential as they return to the valuation multiples they've traded at in the past. There are some risks, obviously. There is some near-term uncertainty, but I think that this is more than priced in. Overall, the fundamentals of these 2 companies are quite strong. They're not materially impacted by the surge in interest rate. Their cash flows are quite resilient to inflation as well as recessions. And so I really like the risk to reward here. You get paid handsomely to wait, and I think that there will be significant upside in the long run. And so that's all I had to say in this video on these 2 REITs. There are many other similar opportunities today in the REIT sector. If you don't want to miss those out, make sure to like this video, subscribe to this channel. I make weekly videos on REIT investing. Also, you can follow me on Twitter if you want real-time news on the REIT sector. And otherwise, thank you very much for watching. See you at my next video.